Opinions and views expressed represent those of the guests and do not necessarily represent those of the station. And now, Paul Ruedi's On the Money.
Tuesday morning, everybody. This is Paul Ruedi. I'm here with the usual cast of characters. Dr. Fred Giertz is in the studio with us today. Dr. Fred, good to see you.
Yeah, good to be here.
Nice to be here. And I have certified financial planner professional and retirement income certified professional David Ruedi. David, welcome.
Thanks for having me.
It's a family affair today. And retirement income certified professional Daniel Ruedi. Good morning. So you can call in with your questions at 356-9397, or you could text us on the Castle Heating and Cooling text line, 351-5357. You can also email your question to talk@WDWS. We are running our Facebook Live, so you can catch that if you are a Facebook type of person. I don't use it all that much myself. We also want to welcome, as I said, those people turning in on Facebook Live. It's important to recognize that past performance is not an indication of future results. You should not make any investment decisions without first consulting your own financial advisor and conducting your own due diligence. Dr. Fred, it seems like this economy is on fire, except not really on fire, but inflation's picking up a little bit. The Fed's personal consumption expenditure, that's what they like to use as their measure of inflation, kind of ticking a little bit above 2% now. That seems to be their target. Unemployment, a 39-year low or something like that, and seems to be not abating. Home sales high. Stock market's doing better. 2 to 5% higher or so much so far in May. I noticed that large cap stocks, which are the biggest companies, are up about 3% year to date. And I'm rounding these. Tech stocks are up about 5%. Very small companies or microcaps are up more than 6%. So the small companies seem to be like this deregulation effect and maybe the tax effect. At least that's what the pundits are saying. But yet, you'd have to argue, guys, that we're probably still in a consolidation phase so far for most of 2018. Not unusual. It's not unusual for these periods to last even longer, so it wouldn't surprise me. You know, we could struggle all through the summer. Who knows? The macro data, as I said, seems to point to expansion, and we just had another interest rate increase, Dr. Fred.
Right.
Nobody's really talking about recessions. We're really now everybody's all excited about higher interest rates. What the Fed has, a dual mandate, right? To try to keep inflation low and to keep unemployment low. Well, we have unemployment extremely low.
Well, right now it's kind of a ideal world because we have very low unemployment and also low, moderate inflation, which is exactly what they want. Now, the world always doesn't work that way. We've had periods like in the late 70s and early 80s where you had very high both. So right now is an ideal thing. There used to be something called a misery index where you added together the unemployment rate and the inflation rate. So sometimes we had a 20% misery rate. Now we have like a 5 or 6% misery rate, which is really great, but since it's great, no one really talks about it much anymore.
Yeah, but interest rates have been ticking up. We have a 10-year Treasury now above 3%. We have a 2-year Treasury around 2.5%, so that's kind of narrowing a bit.
Yeah. This is really the normal, but it's been 10 years since we've been in that range. So we've gotten used to close to zero interest rates. That's not the way the world works in the long term. And I think also people have investors have come to expect the increasing interest rates is incorporated into their decision making. So it's not a big deal anymore. And the Fed's not likely to stop. They're going to go moderately into higher rates for some time.
And it seems like with this tight labor market, though, that would be kind of the beginnings of pushing up labor costs.
Yeah.
Is that a significant component of inflation?
Part of it, but I think the other side of the coin is higher labor costs is also higher wages, and we haven't had that happen very much until very recently. As we talked about several times, we had first a jobless recovery, then we started having jobs being created, but then we had a recovery where we had very little wage growth. That's starting to happen now, which is probably a good thing. And again, there's always the problem. There are lots of people who don't have jobs. There are lots of businesses who want to hire people and they can't find them. So there's always this kind of mismatch situation. But it's, I think, lower now than it was in the past.
And it's really, as far as the interest rate, alarms that people seem to be raising now, But that's really an indication that the economy's stronger, is it not?
Right, getting back
It's a natural cycle.
You would not want the long-term interest rates to be zero, suggesting that we're in a perpetual kind of recession. So I think it's actually a positive thing right now.
And I think they've raised interest rates 0.25% 5 times now.
Yeah.
It reminds me back in 2004 to 2006. Every time, I think there were 7 or 8 of them in a row. Every time was 0.25%. If they really feel the economy is as strong as it is, or at least the nominal gross domestic product, et cetera, why do they always lately, or at least in recent times, kind of make it that predictable? You can almost bet that it's going to be 0.25%.
Yeah.
They've done it before where they have announced, just why not do 0.5%?
I don't think they view it as any immediate kind of problem. So doing it gradually, I think, is probably a better thing for the markets. They don't view it as a kind of crisis situation where they have to act quickly, as they might if they lowered rates drastically during a downturn or thought that inflation was in a unstable stage, but it's not right now. So they have the luxury of doing this slowly. This is one thing people probably are pleasantly surprised about how little the Fed has changed from one administration to the other and one person in charge to the other. So the Fed is carrying out pretty traditional kinds of activities right now.
So pretty classical, and it seems a little bit like a Goldilocks scenario. As I said, we've had a couple of corrections this year. Excuse me. We've been able to put those corrections, put money to use. I'm just a chicken, so anytime we take on new clients at all-time highs, I tend to dollar cost average, and the guys aren't as Daniel and David and Ryan and Paul, they're not as chicken as I am. We might even talk a little bit about that today, but I'll take 3 to 6 months, and so we had those opportunities when the market was down suddenly 10% to go ahead and put that money back to work. And I think, Dave, we're pretty much everybody, we've been dollar cost averaging in. We're pretty much there unless they've come in the last week or two.
Yeah, I think so. I can't think of anyone in particular that we're still doing that for.
Yeah, and so, towards the end of last year, we're chronically telling people at least once a year you want to look at your portfolio and your allocation.
Yeah, the good news is that those opportunities have been pretty short. It goes down and comes back up fairly quickly. We've said many times that the world doesn't always work that way. You can't expect a correction to be reversed in 6 weeks, as has been the case in the last couple of years or so.
There's no question about it, and volatility's kind of declined and waned a bit. Everybody's getting all excitable in January, February, a little bit in March, and that seems to be waning. And but it's interesting. I was watching the flow of money in and out of mutual funds. And kind of just like 2009 to 2013, when investors were really just kind of unsure about where's all this headed, there were a lot of massive reductions, people selling into this bull market, which was a mistake. And we're kind of seeing that again in the recent data. I just thought that was kind of interesting. Wanted to point that out. I want to go to Daniel. Daniel recently wrote a blog addressing one of the most common questions we get from clients. Really, anyone who's thinking about investing their money, the article's called "Is Now a Good Time to Invest?" which people can read at ruediwealth.com, and those for watching Facebook, we will put a link in the comments. So people rarely elaborate, Daniel, on what they mean by, hey, is this a good time to invest, or is this a good time to add money if they're thinking about it? But you mentioned in the blog there's and I've used this concept before. There's a question behind the question generally, or under the question. First, really, what they're asking you to do maybe is, hey, is this a good time? It's really a timing decision, so a market timing aspect to it, or a prediction or a forecast. But behind the question, I suppose there's this: is this going to hurt me? If I do this, am I going to regret it? And we know, and we talk an awful lot about investing, and one of the things that really investors struggle with is the emotional component of investing. And fortunately, and that really centers around more about fear and regret than anything. But there's really a way to kind of mitigate that, and you wrote that post, which I thought was really good. When we talk about that question behind the question, what is it about? Is the market going to go up? I mean, isn't that really what they're asking?
Right. And each time, it's similar for all of us. We all go, well, I don't really know where it's going to go over the next day or the next month or maybe in the next year. But what I can tell you is over long periods of time, you're going to be better off for this decision, as long as, of course, your money belongs in the stock market.
And that's the key. It's like, well, if you're asking me, look, if my plan says, look, this new money, because of where the plan is right now, looks like most of it's headed for the stock market. So that's your whole point is, we're not really deciding which one to put it in.
Right.
Saying, okay, Daniel, I know this needs to be in the stock market for me to achieve what I want to achieve and for my allocation to be aligned with what I want to have happen.
Right.
So that's kind of the prerequisite for it. And so then they're really asking, then, is this a good time?
Yeah, and I mean, we usually have a pretty good understanding of, what the probability of you being up is versus, down to the year, 10 years. So, if they're saying, well, what's it going to look like in a year? I could pretty much only tell you, historically speaking, 64% of the time you'd be up over T-bills or something like that.
So if you're going to say, well, we're saying if I don't put it in the stock market, I'm going to put it in something like a treasury bill. So it's like, what they might be asking you is, am I going to do better than that?
Right.
And you're saying about 2/3 of the time, historically speaking, the odds are that a year from now, you will be glad that you put it in the stock market if it belonged in stocks in the beginning.
Right. And then just 5 years, you're looking at 67% of the time, and then 10, it goes up even more to 88% of the time, and then 15, it goes up to 91% of the time. And that's why it's important to look at what the money is for long term. I think people think long term is in a year. No, long term's 10 years, 15 years.
And you guys probably notice I try not to use the term long term if I can avoid it. I try to use the term lifetime.
Right.
Look, you're going to own these for a lifetime. Now, everybody's lifetime's different, and everybody gets that. But when we sit there and talk to the 70-year-old client and we say something like long-term, they'll say, well, they're thinking inside, well, wait a minute, your long-term, Daniel, at 26 years old is different than my long-term. I'm going to go find a more. And so you're saying if you're a lifetime investor, focus on that. I'm really in this for the duration.
Right.
And so there you have the statistics. I have found over my 35 years that, I've always said, I wrote a newsletter one time, I'll probably recycle it. Historical doesn't compete with hysterical. So we can talk about historical data, but really, in light of those statistics, it's really this issue, we've talked about it before, this primal fear, this primal condition of, am I going to regret this? Am I going to feel pain if I do this? Because people are trying to avoid that pain.
Right. And I think that's where it's important to know what you're getting yourself into. Depending on your asset allocation, you should be able to look back at, I'd say, the last 3 bear markets and say, what would my portfolio have looked like at that point in time? And can I handle this?
Right. Because it's a package deal. And we do that just as a practice. We create an investment policy statement for each client. And part of that investment policy statement is it's kind of a memorandum of understanding. Look, let's memorialize all the conversations we've had prior to this. Here's where we're headed. Here's the time frame we're talking about. Here's what the purpose of the money is. Maybe it's to fund a retirement for the next 2 to 3 decades. Here's the allocation, asset allocation, which is how much in stocks versus bonds. And it's kind of all down into 1 or 2 easy to read pages. But part of that is, look, here's the asset allocation we've just but let us remind you. And what's interesting about the last 3 bear markets, and a bear market is just a market decline that everybody agrees, generally speaking, is down to a broad U.S. market or a broad market decline of 20% or more. And I find it, I call it the good, the bad, and the ugly. I don't know if you guys picked up on it, but when you look at the last 3 bear markets, well, we count 2011 as one, even though it was just a hair shy of being down 20% in the broad U.S. market. And a basic 60% stock, 40% bond portfolio might have been down 10, 11%, 9, 10, 11%. That's pretty standard for that type of allocation. But when you go to 2008, 2009, I think it was down 35 or 36, 37%, which is highly unusual. So that's what's on the other side of typical. And then the one prior to that was 2000 to 2003, where the portfolio would have been down very little, which was highly unusual. So I call that one the good. The bad is typical one like 2011. And then 2008, 2009 was the ugly. Ed's trying to get a hold of me here. Is there something? I'm not seeing it on here, so sorry about that, Ed. He'll come in here and yell at me, tell me what to do. So emotions are, okay, Dr. Ed, this is all that's up there on the board. Sorry, ladies and gentlemen, Ed's going to get me figured out here. It's got a lot of fancy stuff on there. Oh, okay, so we have text. Could you discuss the advantages and disadvantages, and Daniel, we'll get back to your blog. Could you discuss the advantages and disadvantages of an inherited IRA from a grandparent to grandchildren? Also, is there any limit on the amount that can be directed to grandchildren? They are in their 20s, and I thought the growth with a required minimum distribution could benefit both of them down the road. What are your guys' thoughts about that? I mean, look, I guess it's coming from is this a good idea for me as a grandparent to name one of my grandchildren as a beneficiary? What say you guys?
Well, I think we can start with the obvious advantage of, if you're giving that inherited IRA directly to a grandchild instead of your child, the grandchild's going to be younger. And what that allows them to do is stretch out those required minimum distributions even longer. So the way, for the listeners who aren't familiar with inherited IRAs, the way they work is it's kind of like how after you turn 70 and a half, the government requires you to take a certain amount out of your IRA and pay taxes on it so that you can't just defer taxes forever. Well, the same thing applies to an inherited IRA. So when whoever the beneficiary is inherits that IRA, they're going to have a required minimum distribution amount from that IRA every single year. And that amount depends on the age of the beneficiary. And so the younger the beneficiary, the smaller the amount, and the longer you get to stretch out, or in other words, keep the money in that IRA and let it keep growing tax deferred. So if you're talking about maybe instead of a 50-year-old, a 20 or 30-year-old, that can be a fairly significant difference.
And it's a when you think about it, if someone's in their 20s, it might be with required minimum distribution rate below 2% or so. And then each year, basically your life expectancy, you add a year to it, and then it's one over that number of years. I don't see there's any downside in it at all, assuming that that they're responsible enough to handle it. Daniel, your thoughts?
Right, that's what I was going to say. I think one drawback is that although you have to take out that RMD,
which is required minimum distribution.
A required minimum distribution, you need to make sure you're comfortable with your grandkid, responsibly speaking, because
right.
He could take out the whole thing. It's theirs, It's not like, well, he's only going to take out the RMD. It's like, well, if he's responsible and he understands it, maybe you explain up front, this is what I want for you to have this for.
Yeah, it's not unusual to kind of provide instructions with it. I've suggested to a number of my clients that, look, just put it in writing. Mary, I've done this for you upon my passing, as for your retirement that's maybe 40 years down the road. My best advice is to just hold on to it and do nothing. And if you have to take the required minimum distribution, it doesn't mean you have to spend it. So you get to put a little lecture down on paper, and you hope to do it. The other area is Roth IRAs are also wonderful things to inherit. Of course, that's the tax-free version of it, as long as you follow all the rules. And while they're still required minimum distributions, they're not taxable.
Right.
But both of those are wonderful things. And there's a lot of grandparents that will tell their grandchildren, or parents that will tell their younger children, just as an aside, while we're thinking about this concept of helping our sprouts or our grand sprouts, that look, if you have a summer job, for example, and maybe you make $2,000 or $3,000, and to incentivize that person, that child or grandchild, you say, look, if you'll put, for every dollar you put in your Roth IRA, I'll match it up to, you get up to your maximum contribution. So I'll give you enough money that you to your maximum earnings, and we'll match it. And that's quite an incentive, and I've seen that work quite effectively at the same time.
Yeah, that's the real issue. I mean, the magic of compound interest may escape the knowledge of a 20-year-old who has several $100,000 coming their way.
So maybe along with that letter, you put in a time value of money chart, a compound interest chart, and highlight 40 years at, say, 8% or 10%, if you're looking at the long-term historical compounded average growth rate of the U.S. broad market with dividends reinvested. And that maybe that'll get their attention, or maybe it won't. This is always a dilemma for parents and grandparents when we're talking about leaving in a legacy or an inheritance to young sprouts. Is most of the time, of course, there are ways to control it. You can create trust, etc., for children that knowingly can't handle a big lump sum of money, and that's not all that complicated. But generally speaking, most people like to leave it, to their children or grandchildren outright and hope that they'll do the right thing. There's absolutely nothing wrong with writing down your wishes with a little information, a book or two. Maybe the check is in the middle of a really good book, like Investment Policy Statement, or by Charles Ellis, or a book on common sense on mutual funds by Jack Bogle from the Vanguard Group. There's several of them that might be worthy constituents to do that for. So I don't see any downside to it. I'd like somebody to. I'd be happy to inherit something.
You have to do it very, very carefully too when you transfer an IRA. That if it's not done correctly, there's a five-year rule.
Right. So you want to make, as you're saying, you want to make sure your beneficiary designations are all properly done, and check with your advisor or your lawyer to make sure that you're not going to do something that, instead of being able to take advantage of that lifetime stretch rule, that you're forced to take it out over a 5-year period, and it's a much shorter period. This comes down to when there's multiple beneficiaries, for example, or of trust that's trying to be set up as a bypass trust that isn't really quite drafted properly, and some of the people are not individuals, they're maybe institutions, and there's some real clutter there. You just want to be careful about how you do that. It's a good point, Fred, because you don't want to inadvertently have that ability to stretch out those payments maybe over 50 or 60 years shortened to 5. But that's easily remedied.
Or even people will miss required minimum distribution sometimes. I mean, how many 20 or 30-year-olds know what a required minimum distribution is?
Well, they should get it from their institution, but in the event they don't, and the penalties are pretty harsh.
Yeah.
50% is, I think,
of the amount that you didn't pay but should have.
Right. And so you really you want to follow the rules, but that's any reasonably good advisor can walk you down that path, us included. Even we could even do that. Daniel, getting back to your blog, just kind of about emotions and the question under the question of, is this a good time to invest, and really, is this a good time to invest in the stock market? You mentioned, which I think is the key ingredient, is if that question is answered in the backdrop of a plan. Mm-hmm. That really kind of mitigates and really reduces that emotional aspect of it, does it not?
Yeah, because it's kind of giving your money meaning, because if you're just looking at your portfolio fluctuate, you might be scared because you don't know what it actually means for you. Is it going to affect my life that there is this decline? But when you have a portfolio in relation to a plan, then you get to say, okay, well, my portfolio did decline X amount. Well, can I still spend the amount I'm spending? Do I still get to go on the vacation I'm spending? Things like that. So I think it's important to, and then you can look at those things and just be like, okay, well, I know this decline happened, but it looks like my plan's still okay. I can still spend the amount I want to spend. And I see for clients that gives them a lot of reassurance to go about their day, In
other words, we've anticipated what you're afraid of. What you're afraid of, Mr. and Mrs. Ruedi, is you're afraid that you're going to put this in at exactly wrong time. You feel like you're that person that could be the author of the book, How Come Investments Work Until I Buy Them? And I understand that. But please understand that we've anticipated much worse. I assure you, we have anticipated decline, not predicted, anticipated declines in your plan that are much worse than you're anticipating. And that's part of the package deal. If you don't feel like that is settling enough, it might be getting in the way of them actually funding their plan with the allocation proper. This is where we get back to dollar cost averaging. So I'm going to ask each of you a question. I'm not in the room because I'm highly opinionated, as you know. A new client comes in and you do a plan for them. And right now, 30% of their assets are in the stock market, 70%, and you haven't done anything yet. You just showed them your plan, and your plan says that they should have 60% in the stock market instead of 30% of their money over their lifetime. We're 5 or 6% from all-time highs today. David, I'll go with you first. I'm not in the room. Are you going to dollar cost average? And there's no right or wrong here. Just I'm trying to give the listeners. Someone sent us a text a show or two ago. There are things we disagree about. This might be one of them, and there's no right or wrong. Are you going to dollar cost average? What are you going to do? They have 30% now. They need 60. When are they going to get to 60% stocks?
I think the answer is that it depends on the person's specific situation. So an example where I would likely dollar cost average would be if someone's going to be taking fairly heavy portfolio withdrawals. So say it's someone who's just about to retire,
okay,
and the plan says, okay, we need to increase their equity allocation from where it is now, and starting a month from now, we're going to start withdrawing X dollars per month. That's just switching to retirement in general is already emotionally taxing enough. Doing that, increasing your equity, is going to be emotionally taxing, and you're more sensitive to portfolio declines during that time frame. So that's a situation where I might propose, typically I like to invest at least half right off the bat. Now they're already kind of there. So
you're going to split it. You're going to say, well, you're 30%. I'm going to cut the other 30% that belongs in. I'm going to put in half of that. So now I'll be 45% stocks towards my 60% goal.
Right. And then I'd probably dollar cost average over the next 6 months or so. But I would have a discussion with the client first. I wouldn't just do it. Reason being, I know that objectively, going back to the statistics that Daniel mentioned, about 2/3 of the time you're going to be worse off for having dollar cost average. So you just
compared to just keeping it in a money market fund or bonds.
Exactly. So you just explain that to the client. You say, look, in the grand scheme of things, it really won't make a difference, but chances are it's probably going to cost you a little bit to do this. Make sure that they're okay with that. Explain your rationale for thinking that dollar cost averaging is appropriate. You got a lot of emotional kind of stuff on your plate right now to deal with. And I think in the long term, it's going to make this whole process a heck of a lot easier. So that's one. The flip side of that is, say it's someone who isn't taking portfolio withdrawals at all. It's a 40-year-old, and for whatever reason they have a mostly bond allocation. I'm going to say, look, we're going to your target allocation right now because it's irrelevant if the market goes down immediately after we go all in. As long as you can keep your head, we're not selling anything. You should be a little bit less emotionally sensitive to that. So because of that, the fact that it's just totally irrelevant if the market goes down over the next year when you have another 60 years to invest, I'm going to suggest just putting it all in at once.
And Daniel, you?
I mean, Dave was spot on. I just, like he said, there's an optimal way to do things, and then there's probably, the reality of it. And that's just the reality. Some people can't handle just going in all at once. So just find a happy medium. I mean, over a long term, in the grand scheme of themes, it's not going to be like a huge deal. It
doesn't really move the needle all that much from a financial planning standpoint, but from an emotional standpoint, it might move the needle a lot.
I
was going to ask you, Fred, kind of what's your spin on this after?
My logical spin is, put it in today. I actually had a situation with a foundation where there were several $1 million that had to be put into the stock market, and I flinched and put it in over several months. And actually, it turned out tremendously lucky. It was beginning of 2016, so we spread it out. So it turned out, it looked like I was really smart, but I was just afraid to go all the way.
Yeah, and the problem when people do that, or the majority of people, is it can easily train you to think, well, that's always the way to do it. And like you said, you admitted it's really luck because it's unpredictable.
If you make a big change, you don't want to come back to the board after 2 months and say we've lost 10% of the investment. So it's partially a kind of cosmetic situation.
The way I think of it is like the cost in terms of potentially foregone returns is going to be relatively small over your lifetime. The cost to never getting to the allocation that you need is huge. The cost to panicking because the market tanks right after you get to your allocation is huge if you sell out because you panicked.
And I think that's where you said up front, you really have that thorough discussion saying, look, odds on you'll wish you would have done it all today before sundown. However, recognizing that the first year or two of retirement, when you don't have a paycheck any longer, that's showing up on a steady basis, you're not adding money to a 401k, you're actually spending money from your 401k. So we've gone from accumulation to decumulation. That's just where it has to take a little bit of finesse and explanation. And generally the clients, most of the time, I think if we're near all-time highs, they seem to be more comfortable dollar cost averaging into the position. We don't do it overly slowly. But the other thing you guys will do, and I know I do this, is suppose that you take that you take that client you talked about, you take half of it, you put it in today, and you're going to dollar cost average the balance maybe over the next 6 months. And then you get a market correction like we had in January and February, March, a couple of 10% down, pretty quick declines. That's when you can speed it up at your convenience, correct?
Yeah, you can. And I think the key is just to realize that there's nothing scientific about that, and it's not like you can guarantee that you're not going to put maybe a double contribution in and then it continues to go down from there. There's always that possibility. So I think you just have to realize kind of those considerations if you're going to consider speeding things up. But like you said, chances are, say it's even more extreme, 10, 15, 20% decline, it's probably not a bad idea to just
So Fred,
it's hard to guess too. I've told the story several times, but I make contributions to the 529 plan to my grandchildren, and my strategy is always to wait for a dip, but I never get the dip right. I end up doing it in December every year, close to the market high.
Yeah,
so waiting around for the right time is it's harder to do than it is to think about it.
So Fred, one of your children inherits $200,000 from Aunt Betty today, and they say, Dad, this is going to be for retirement. I think this is just going to be the last piece that fits my retirement puzzle. I think I'm in good shape with this delightful inheritance. It seems to me, Dad, that most of it probably belongs in the stock market at my age, because I still have 10 or 15 years before, or maybe 20, before I actually need to call upon the money. Now what's your advice?
Well, again,
realistically, if that
would
happened today, what
I would do what David said. I'd say put half of it in now, and then put it in over the next several months, just to avoid the having a shock where the child might be afraid of the market for years to come.
And I think people underestimate those shocks. I think that surprise. They should never be surprised, but people in general are surprised every time the market tends to do what it normally does, perfectly normal cyclical declines, and but they always seem to be surprised nonetheless. And so this is the side of the business that we're kind of letting people in on. Nothing is cut and dry. This is where getting to know your client, getting to know their personality, kind of how they feel and talk about money, how they grew up around money, how they feel about just all these emotional things. And so I think that was worthy of talking about. And that was a really good blog, and I would blog. I'm thinking of Blagojevich, I think. Really good blog, Daniel, at blog.
One other point too. Any kind of insurance comes at a cost. So if you want to insure your portfolio, you could do it yourself by a mix of bonds and stocks. There are also ways of trying to insure it, but it's expensive. So you have to ask yourself, how much would I pay to avoid a 1-year downturn, and paying 1% a year forever to avoid a downturn, which is going to recover in the next year or two, is probably not a very good investment. So insurance can come in various ways. You can kind of self-insure by having a balanced portfolio. You can buy various kinds of instruments that guarantee lower the downside risk, but those are usually very expensive kinds of options.
Right. There's trade-offs, and really all what people should hope for with their advisor is to show me the trade-offs.
And it's different too. I mean, if you buy insurance on your house, if your house burns down, it's not going to regenerate itself.
Right.
But generally, a market downturn will.
So far.
Right? Yeah.
I mean, it's almost. When I talk to clients, and of course, I'm the eternal optimist, but I just look at the stock market as just a collection of all these really bright business people that innovate and make things better and cheaper all the time. And so to me, as long as one has a lifetime to consider. The uptrend is permanent. Well, we don't know the slope of it. We don't know whether over our lifetime we're going to earn 10% compounded, 6%, 4%, or 9%. There's a distribution of outcomes, but it's kind of safe to say. Well, it's not safe to say, because if I was on the radio or I put in print that the stock market always recovers, it's always, let's put it differently, it's always going to recover.
Yeah.
I'd probably get in trouble for that, because
Well,
you can't say that it's always going to recover.
Yeah,
But
if
it didn't, Fred,
Yeah.
over one's lifetime, if it didn't recover, what would it require? The stock market goes from 25,000 to 12,000. 50 years from now, it's still not above 50,000.
Yeah,
but it did. I guess it still recovered from its lows.
Right.
Well, let's just say it didn't recover from its lows. It went to 12, gets cut in half, and goes to 12,500 and never leaves there.
Well, you're in bad shape, regardless.
I mean, you really got economic
again,
collapse and reset.
Again, which
could happen.
If we were speaking Spanish in Argentina, we'd have to think about some negative 100% in there. So if you have a negative 100% return in a year, you're out of business.
Yeah.
But we've never had that in the United States, and no one foresees
But you can't say it's impossible.
Yeah, but in that case, there's no safe haven in those kind of situations.
So I guess it's, for practical purposes, we always want to say, look, if you give it enough time, which is nebulous, right? I don't know if that's 3 years, 5 years, 20 years from now. There's no assurances that the stock market will be higher than it is today 20 years from now. Probably going to be, if history's any guide. Yeah. And it's the only guide we have.
We'd be unfortunate, though. Germany had two war situations where the market was wiped out. But we haven't had that. No one expects that.
Well, Fred, when you go to war with the world, it's one thing to go to war with another country, but when you pick on the world, that's probably not a good idea.
It's just more support for kind of international diversification too, not just investing in your home country, because who knows what can happen to a single country, but chances are that's not going to happen to every single country.
Isn't that the lesson of Japan, Fred?
Right.
I mean, remind people from the 80s when the Nikkei was on fire and it went to 40,000, and I think today it's somewhere around 20 or 25,000. Yeah. So there's that 30-year period where it hasn't recovered.
And that was a real test to using the market cap weighting as a index, because the international index became strongly Japanese during that period of time. And in retrospect, that everyone knew it was a bubble. They shouldn't have been there, but,
of course.
But they didn't know it when it was happening.
But think about a Japanese investor. I've said to clients before, and I don't mean it really in a negative way. I don't trust any country with 100% of my money, not even my own.
Yeah.
And if I was going to trust one country with my money, it'd be this one. But think about that Japanese investor if they had 50% of the Japanese stock market, is a broad market, and 50% Standard & Poor's 500 index. Now, they didn't have spectacular returns, but they had reasonably respectful returns for the next 30 years instead of really what turned out to be a disaster for many investors. Right. And so that's a good point about this is all, we always circle back to certain things, and diversification is one of them. There's always a benefit, even when you wish it wouldn't sometimes. I guess there's always a benefit to diversification, but it doesn't mean there's always a better return because of diversification. You're getting some type of benefit. Daniel, you were quoted in U.S. News article, Mr. Big Pants there, and it's on the social media page of our website as well. But I thought it was an interesting article because simplification is a big theme when it comes to people when they retire. They seem to all of a sudden, if they haven't been people that wanted to simplify, there seems to be more focus on simplification of our financial affairs. Why did you feel like you wanted to add to that article in U.S. News?
I thought it was kind of interesting because I think sometimes as financial advisors, we feel like everything needs to be very technical. And I was just like, no, this is a simple question. Sometimes when you have too many accounts, you get older and you forget about some. I mean, it's as simple as that, and that's pretty much what I said in the article.
In the last 3 years, you've seen that.
And I've seen that, and it's something that people don't really talk about much, but it is something that really affects a person, too. If someone passes away and they have no clue how many accounts they have or anything like that, I mean, we're dealing with it right now with someone. They're like, hey, I found another IRA the other day. And it adds another layer of stress. And you don't want to do that, especially later in retirement. So why not simplify while you can?
Do some people, Dave and Daniel, and maybe even Fred, kind of confused? Like, well, if I simplify it, have fewer accounts, and maybe they're all at one place instead of several places, that somehow that's a layer of diversification I'm giving up. Is there a tendency to think, well, maybe that's having all my eggs in one basket?
I think psychologically that definitely plays a role with a lot of people. I think they forget, though, still, first of all, there's just downsides to having your accounts scattered amongst a bunch of different places as well, so you have to kind of weigh those. But, at the end of the day, I think people forget that, if you're a really like a passively invested investor like we suggest, you're using index funds.
Which means you're not trying to out-time the market, you're not trying to outperform it by picking and choosing winning stocks versus losing stocks, because that's a loser's game.
Right. So if you're invested in that way, you're basically owning most of the stocks across the entire global stock market and bonds across the global bond market. It really doesn't matter the number of mutual fund companies that you use, because you're owning all of the stocks in all of the companies. It's just unnecessary name diversification. Or if you have two financial advisors and both are owning super diversified mutual funds, you're ending up in the same place with more complication. So
we have a pretty strong position on this, and some people think it's self-serving, and it's not, because I'm very careful the way I phrase this. But my experience is, if you have two advisors, you really don't have any. It's kind of the old saying, a person that chases two rabbits doesn't catch one. And it's this idea. And so I always tell people, look, begin to simplify. And part of simplification is find one advisor if you're going to use an advisor. Don't try to use several. You're never going to end up with a cohesive, coherent plan. But pick the one carefully. And I always tell them, look, it doesn't have to be me, but my best advice is find a really good advisor. Fred, if someone had all of their money, I'm not promoting any particular firm, whether it's a Fidelity or had all of their money at Vanguard or Charles Schwab, anything to be overly concerned about that? I have all my financial accounts at one major brokerage firm.
Well, again, I'm not a legal expert, but my understanding is that you own the underlying stocks. So if something goes wrong with the institution, the ultimate fallback is you somehow get the value of the stocks themselves. So it doesn't protect you against a market downturn, but you are protected against some kind of failure with the brokerage firm, which means you don't want to. Again, I think you've said many times that you generally don't write out a check to
your advisor.
Your advisor, you write out a check to someone who's some institution.
There's usually a custodian that's a third party. When you're working with an advisor, where people get into trouble is when they don't. As you said, the first time I heard about Bernie Madoff and that scandal and all the billions of dollars that were lost, somebody asked me, how do you think that happened? I said, I know how it happened. I don't have to know it. I don't have to read anything about it. I know how it happened. That money was commingled with Bernie Madoff's money. That is, they actually took custody of that money. So if you have a financial advisor, I would suggest that nobody hand over custody of their assets to their financial advisor. You can hand over the authority to place trades or to send you money at your address, things like that. But you never want to give custody. So, if it's Bill Smith Company, financial advisor, you wouldn't want to be making checks out to Bill Smith and Company. You'd want to see something like a Ameritrade or a Charles Schwab. I'm just naming some of the most popular ones with financial advisors: Schwab, Vanguard, Fidelity. There's others. There's many others. It could be local. It could be a local bank, a trust company, for example. That's what you want. You want that layer. So one of the things you want to always be careful of is, look, if I'm going to entrust my lifestyle, because that's what you're doing. You're not entrusting your money when you hand it over to an advisor, financial advisor. You're handing over your lifestyle. You at least want to be in a position where nobody can steal it. That seems to be pretty fundamental.
This doesn't eliminate market risk, but it does eliminate default risk of an institution, something of that sort. So even insurance companies can even have problems in terms of. So there's no. But ultimately, you have control of the assets themselves.
All the assets are segregated at these major brokerage firms. The only time where it looked a little bit concerning is when MF Global, a few years back, maybe it's 5 years now, went under. There seemed to be a little mixing of assets, but it turned out that from what I read, those were people that had margin accounts. And once you have a margin account, which means that you've signed the ability to borrow money against your securities, which also means a lot of other things, it just means it's a little easier for the brokerage firm to get in there and play around with your money. I mean, in general terms, it opens up that little layer that isn't there if you have what's called a cash account, which is just, look, I'm just going to buy securities. I'm going to own those securities. You're going to put them in book name and with my name on them, as Fred said. Then if a brokerage firm goes under, and they can go under. We saw Lehman Brothers go under. We saw, there's Lehman and
Bear Stearns.
Yeah, Bear Stearns. There are a number of them, and that's not what caused people problems. I mean, if they owned Bear Stearns stock, they had trouble. If they had Lehman Brothers stock, they had trouble, or Lehman Brothers bonds. But for people that had their brokerage accounts in a cash account, I'm not aware of anybody that had any issues as far as getting their money back, because those assets are segregated from the firm's own. And then there's SIPC insurance up to a certain levels, $500,000 typically. And then most brokerage firms tend to carry other blanket coverage for hundreds of millions of dollars. But you just don't ever want to be in a position where your advisor has custody of your funds. So that's one layer you want to. I know we're going off a little bit of a tangent, but I thought as long as we're just kind of talking in general terms here, these are probably important things to know. So that's one. The other is, well, okay, so we can't steal my money. Well, maybe they can do something bad. Well, you owe it. There's a certain responsibility investors have. I think okay. I'm going to go to a text. My daughter, sorry for jumping all over. My daughter is going to receive an insurance settlement for injuries in an accident, maybe $200,000 or more. She's 17, about to turn 18. I'm concerned about negative impact to our FAFSA college funding application. Also, do you have any advice about an annuity for yearly disbursements dealing with a young person with too much cash too quick? Well, I've done a lot of expert witness work for law firms where this question comes up a bit. The latter part of the question is, are we better to take a structured deal or are we better to take a lump sum? You really want to have a really good financial advisor who is in really good command of the numbers and really figure out what they're offering you, because many, many times the way they're structured these offerings are in a way that's very tricky, hard to figure out, and you don't end up getting, when I say money, I mean purchasing power. Structured settlements can really leave you short. That's why a lot of insurance companies like to have structured settlements. They know they have a better command of the numbers most of the time than even the attorneys, unless they have a really good expert witness. So I've been able to do that. So my advice there is to find a really good financial advisor that can crunch those numbers and show you basically side by side. Look, here's the pros of taking that structured settlement. Here's the cons. Here's the pros of taking the lump sum and investing it, but here's the cons. And there are pros and there are cons. Some people, that doesn't mean people shouldn't take structured settlements. For some people, it's the only appropriate way that they're not going to make it out alive if they don't have a structured settlement. Some people are better off and can handle taking the lump sum, and it's more beneficial to them. As far as FAFSA, Dave, I don't know. I haven't really come across that where somebody usually it's an injury, it's a settlement for these types of things. It's tax free, but I don't know how that would impact FAFSA. That's one thing I've really haven't come across.
I would think it'd at least be counted as an asset.
Well, it would be day one. If you took a lump sum, it would be an asset. Now, if you took the annuity stream, it's going to be an income stream.
Right. And as far as comparing those two and the impact on FAFSA, that's kind of outside my level of expertise when it comes to college funding.
It's strange that college age is actually more complicated than the income tax laws. I sort of understand the income tax laws.
It
can be. But again, there's also another question whether the damages are being paid for pain and suffering versus lost income. So that might be an important question to have the lawyer look at.
I think you really want to tie into somebody who's an expert who lives and breathes 520 or college planning, not 529 planning, college financial planning. And I've even gone over to the U of I office here, and they're pretty knowledgeable over there about these things. So sometimes, since you're in a university town, so you just, especially in the summertime, more availability, and they've been, at least historically speaking to me, been pretty available to talk about such things. And I think that might be a really great place to start right over here at the University of Illinois if they'll accommodate that, and I wouldn't be surprised if they would. Guys, well, we've talked a lot of stuff today. We got a couple minutes to go. We talked about your blog, Daniel, about the question under the question, is this a good time to be in the market, or is this a good time to invest? We handled that, I think, pretty thoroughly. Simplification, we're big proponents of it. Daniel was mentioned in U.S. News in an article. That's why we brought that up. There is a certain reluctance to simplify, but the benefits, we get to see the benefits to it, because as people get older, I think by the time they're 65, they begin to lose about 1% of their cognitive ability from what I read. The way I understand it, anecdotally, that seems to be true to me, just for my 35 years of seeing people go from their 50s to their mid-80s or 90s even. But simplification has a lot of benefits. It benefits the client. It benefits the children. There are some effective ways to do it along with simplification. We have Everplans that we provide for our clients. I'm sure other firms have their versions of things or have the same version, which not only allows you to get to that simplification of how many accounts you have and where they're all scattered about, then recording them where your children or certain children have access to the information in a very sensible fashion, a very orderly fashion, and you can kind of take that in baby steps. So I think that's pretty good. Fred, I guess we're just going to put up with more interest rate increases, right. Mortgage rates.
Yeah, one quick
really
thing.
high. Yeah, Fred.
I went to a meeting this week about taxes. So people who are running small businesses have some important decisions, and no one knows how to deal with them. There's a new pass-through rule, and people probably should be thinking about that, but it's almost too soon to know what to do right now.
I agree. There's still some pretty significant confusion about some of the tax laws that were passed recently. And, well, we're glad everybody was able to listen today. This is Paul Ruedi for Dr. Fred Giertz, Daniel Ruedi, and David Ruedi. Thanks for listening to On the Money.
Join us for the second and fourth Tuesday of each month